Okay, right. So guys, very good afternoon to all of you. We'll stay for a few minutes, like let's say around 3 to 4, and then we will start the session. We'll just see whether others are joining. Okay. Okay, right. So guys, then let's start today's class. So today, guys, we will be focusing on uh, consolidated SOFP. Right. So last class we were focusing on preparing financial statements, right? The adjustments like depreciation, provisions. So those were things that we were focusing on the last class. So today, guys, we will be focusing on consolidated SOFP. So guys, remember whatever that I'm going to teach related to consolidated SOFP, the short note is shared in the TRJ group. I think today is where I actually shared the notes. So whatever that I'm explaining, right? Double entries, shortcuts, formulas, everything, right? Everything is in that short note. So if you just study that short note over there, you will have like a complete guideline on how consolidated SOFP needs to be done. So I'll guys start off a question from the exam kit over here called port and starboard. So first we'll do a question from the exam kit, and then we'll try to do a specimen CBE question like the one that is given inside your platform, right? A sample question is given. Okay, now guys, over here, this question called port and starboard is a good question because it covers all the adjustments related to consolidated SOFP. The entire thing is covered. So that will help us to understand the adjustments one by one. So you can ask me questions, right? The doubts that you have if you didn't understand how the adjustments were done. Right now, guys, when you do a consolidated related question, first of all, always check and see what's the requirement of the question. So there is a section C question where they have asked students, okay, number one, select the formula which correctly calculates goodwill. So the first question is goodwill. So for goodwill, guys, I have put down my formula over here. Normally to calculate goodwill, we have formula, right? So that formula, I have marked it over here, working number 3. Right. Then guys, on the other hand, they have asked a theory question. So we'll check on this one later. Task number 2, complete the following table showing property, plant and equipment. So guys, property, plant and equipment is a non-current asset part. Inventory, then that's the current asset part. Trade receivable, that's again current asset. Trade and other payable, then that's non-current liability. Bank loan, which is non-current liability. So remember guys, in your exam, you don't need to show all these workings. It's just done so that it's easier for me to explain how things work. Okay, then guys, on the other hand, when I go down, task number 3, what amount should be included in the consolidated statement of financial position for non-controlling interest? So non-controlling interest, guys, over here, can you see working number 4, right? Sorry, my bad. Working number 5. Okay, so for non-controlling interest, they're asking what's the value of it after all these adjustments. So for that one, I have prepared, guys, separate working over here called the non-controlling interest working. Then finally, guys, they're asking from us, what is the amount that needs to be included in retained earnings? Okay, so the answer for retained earning is this one, working number 4. So always, guys, in your exam also, this is the first thing that you should be doing. Okay, you need to go through the requirements, and once you go through the requirements, set up whatever that we need. Okay, once you do that, it's easy. You know what you are looking for. Okay, so let's now start the question. So normally, guys, the first thing that you should do when you start off a consolidated related question is that number 1, you need to, guys, set up your group structure, right? You need to show, okay, we bought this company at this percentage and this much is left. Okay, so the very first thing that you need to do on consolidation is try to set up your goodwill. That's the first thing that you need to do. Sorry, try to set up the group structure. That's the first thing that you need to do. Okay, now guys, have a look at this question over here. See, the statement of financial position of port and starboard as at 31st of December 2006. So guys, remember we are doing the question for 31st of December 2006. Okay, now let's go to additional information. The following notes are given. Port acquired 80% of the ordinary shares of starboard. Okay, so they are acquiring 80%. So under group structure, guys, then let me mark this and show it over here. So what's happening? Port, who is the parent, acquired 80% of starboard. S. So understand, guys, when you acquire 80% of the company, 20% is left. This 20% is what we call the NCI percentage. Okay, the 20% is who we call the NCI percentage. Right. On 1st January 2002. Okay, now that's a good thing. Because see, Our question is for 2006. This company has been bought in 2002, meaning several years ago. So remember, guys, if the subsidiary has been bought at the beginning of the year, which is 1st of January 2005, or prior to that, if the company has been bought either at the start of the financial year or maybe prior to that part, then we don't have to worry about anything. The question is pretty straightforward. But if the subsidiary has been bought in the financial year, okay, the subsidiary has been bought within the financial year, then guys, what you need to remember is that there is an additional working where you have to calculate retained earnings at the acquisition date. Additionally, you have to calculate that. So that's a problem for later. I'll pick up a question like that and I'll show you how that is done. But just understand, guys, if the subsidiary has been bought at the start of the financial year or way before that, this becomes a full year subsidiary, meaning the question is pretty straightforward. So here, guys, they have bought the company in 2002. So because they bought the company in 2002, this will become a full year subsidiary. So this is the first thing, guys, that you need to do when you start questions. Understand the structure. Who bought whom? What's the NCI percentage? Is it a full year subsidiary or a mid-year acquisition? You need to figure out that. Okay. Now, guys, once you have figured out that, now can you remember, guys, in this question, they were asking for a few things. Can you see here, guys? They are asking from you, okay, tell us how much is property, plant and equipment. So I got ready with that. Inventory. So guys, inventory is current asset. No? So I'll just show it over here. Okay, they want us to find inventory. Then guys, they want us to find trade receivables. Okay. Right. Then guys, they want us to find trade payable. Then that's a current liability. So I'll write it down over here. Then guys, they want us to find bank loan. So bank loan is, guys, a non-current liability. Right. Okay, sure. So it's like this. Now see that part what you didn't understand. Now let's draw the timeline. Now, when you draw the timeline, our question, they are asking for 31st of December 2006. Okay, 31st December 2006 is where the question is being asked. Okay. So if the question is finishing on 31st of December 2006, then the question should start on 1st of January 2006. Now, in the paragraph that we read earlier, it said that Port acquired Starboard on 1st of January 2002, meaning they acquired way before this. If the subsidiary has been bought either on this day or before this, then the question is straightforward. Nothing to worry about. Okay. If the subsidiary has been bought at the start of the year or maybe before that, then not a problem. So in this question, they have been bought in 2002. So you don't have to worry about anything. But if the subsidiary has been bought in somewhere between this and this, let's say 1st of February, 1st of March, 1st of November, if the subsidiary has been bought in 2006 within this time frame, then there is an additional adjustment that you have to do. So when the question comes in that part, I'll explain how that's done. For the time being, just remember, if your subsidiary has been bought at the start of the year or before that, then you don't have to worry about anything. If they had been bought after this or before this, in between this timeline, then the student has to perform an additional adjustment, which I will teach to you in the next question. Just check and see, are you okay with that part? Okay. Now, guys, remember over here, our exam paper requested a few things. PPE, inventory, trade receivable, right? So what you need to do, guys, over there is that, remember, in consolidation, if it's an asset, now see, guys, they're asking PPE, inventory, trade receivable. These are assets. Normally, guys, in consolidation, how do you deal with assets? Assets are dealt this way. Parent assets are combined with the subsidiary assets. Understood? If they ever ask you a question to show the balance of an asset, always remember how are assets dealt in consolidation. Parent asset is added together with the subsidiary asset. Yes, of course, there are some adjustments which I will explain, but remember the basic is that if they ask any asset, current or non-current, what you should simply do is take the parent one, add with the subsidiary one, simple. So let's start. I'll show you the working over here. So they're asking PPE. So therefore, guys, see, parent PPE is 350. Subsidiary PPE is 265. I'm just going to add it. Don't show the final answer. I'm just showing the working. Then the paper asks inventory. Same story. Take the parent inventory, add that with the subsidiary inventory, and we are done. Trade receivables. Take the parent trade receivables, add that with the subsidiary trade receivable, and we are done. Right. Then, guys, the paper also asks bank loan and trade payable. Guys, same story. If you are dealing with a liability, then, guys, what you need to do is that parent liability needs to be added with the subsidiary liability. Same way. Okay. If you are doing liabilities, so same way. Take the parent liability, add with the subsidiary liability and show. That's all, right? See, for an example, guys, now bank loan, where parent bank loan is 300,000. Okay. While the subsidiary bank loan is 85,000. Right. Then on the other hand, guys, we have over here, when it comes to trade payable, take the parent trade payable, which is 155,000, add that with the subsidiary trade payable, which is 60,000 rupees. This is all what you need to do. So guys, remember, summary, if they ask you to deal with assets or if they ask you to deal with liabilities in consolidation, this is all what you are going to do. Take the parent one, add with the subsidiary one. Understood? But remember, the same thing will not work for equity. The way that the equity is treated is slightly different for the way that we treat our assets and liabilities. I will get back to that after the question. For the time being, guys, just understand assets and liabilities are always combined. Okay. Now, guys, let's start the question then. Okay, let's go through the adjustments. Right. Okay. Now, guys, have a look at this part over here, Roman number 1. Port acquired 80% of the ordinary share of Starboard for 300,000. So to buy the subsidiary, we paid 300,000. This is what we call consideration. Okay. That means to buy the subsidiary, how much did you pay? We call it as fair value of consideration, or maybe we call that as investment. So normally, guys, the amount that you paid to buy your subsidiary, you're marking this inside goodwill investment for 300,000. So 300,000 was spent in order to buy the subsidiary. So that one, guys, we normally mark it over here like this, 300,000. That's it. Nothing more to do. Understood? Right. Let's continue then. At the date of acquisition, the retained earnings of Starboard was 150. The fair value of the non-controlling interest in Starboard at the date of acquisition was 80,000 rupees. So they are telling guys, when the company is bought, the retained earnings were 150. Fair value of non-controlling interest is 80. Right. Now, guys, remember, when they give you this part over here, retained earnings of Starboard. Now, who is Starboard? Subsidiary. Subsidiaries' retained earnings were 150,000 at the date of acquisition. When they give you that piece of information, it's for you to do working number 2, which is called net assets of subsidiary. Now, guys, remember the way that I'm doing the consolidation is the way in which the textbook has taught. Right now, usually, guys, we follow the Kaplan textbook when it comes to ACCA. That's the recommended material. According to that, how the consolidation is done is the same method in which I'm teaching. Right now, guys, working number 2. How to do working number 2? Now, let me teach you. Working number 2 says net asset. Guys, understand what is net asset in accounting? Net asset means, what is net asset? Equity. Okay. Net asset means equity. So therefore, guys, what you do, you go to the equity section. How many examples you can see on the screen? Share capital, share premium, retained earnings. So copy down all 3. Right. So we have share capital, share premium, and retained earnings. Done. Okay. Now, guys, the problem is that now there are so many values. Now, which value are you going to focus on? Right now, guys, always think of it this way. Again, read the working name, guys, for me one last time. Read the working name. Net asset, meaning that's equity of subsidiary. We need the net asset of subsidiary. So out of these two values, when you go to the equity, out of these two, these are the subsidiary values, 60,000, 10,000, 250. Then we should focus on that. Right now, guys, once again, there are so many columns on my table. What am I going to use? Right, guys, listen. What is at acquisition? When the company was bought, how much are the balances? That's what we call at the acquisition date. What's reporting? When we are preparing the financial statements, that time what were the values? That's what we call reporting. Reporting means when you're preparing the financial statements, what were the values? Got it? Last one, post-acquisition. What is post-acquisition? The difference between this one and this one is what we call post-acquisition. Let me teach you guys how to mark the numbers. So again, now you know how to focus on this now. Once again, guys, quick recap. What is net asset? Equity. So I copied the equity. Equity of whom? Subsidiary. So out of these two, which one is subsidiary? This one. 60,000, 10,000, 250. Now these values are for December 2006. Can you see? These three values are for December 2006. Guys, December 2006 is where we are doing the question. That means those are what we call the reporting dates. 60,000, 10,000, as well as, guys, over there 250,000. These are the answers at the reporting date. So just copy it down. Right now, guys, listen carefully. In the exam, at the FA level or at the FR level, which is the next level of financial accounting, share capital and share premium never changes. It's always constant. Okay. This level and next level, share capital and share premium will never change. So copy the same answer over here, 60. This 10,000, copy it over here. Done. The retained earnings at the acquisition date, they will provide it to you in the question, which you have to figure it out. Here, guys, look at this. At the acquisition date, the retained earnings of Starboard was 150,000. Take that and mark it over here. At the date of the acquisition, retained earning is 150. This is how, guys, you should do basic working number 2. Right? Net assets means equity of whom? Subsidiary. So only focus on subsidiary values. All these values were given for December 2006. December 2006 is the day that we are doing the question. That's why I copied it under reporting date. Share capital, share premium never changes. The retained earnings at the acquisition date, guys, they gave it. They will normally give it in the question as long as it's a full year subsidiary. So I just took that answer and copied it over here. Okay, so I'll give you all guys time to clear your doubts. And then, guys, next part. The fair value of the non-controlling interest is 80,000. Guys, in our question, there is a 20% NCI, no? For those people, the value is how much? 80,000. Now, how do we mark that? Okay, guys, listen. For the fair value of non-controlling interest, this is your double entry. Fair value of non-controlling interest, the student has to copy it inside the goodwill working. So when they copy it inside the goodwill working, it will become debit. Debit here, 80,000. Normally, guys, NCI is used in goodwill. So when you write it in goodwill, goodwill will become debit. Then where is it credit? In the non-controlling interest working, you go and copy it over here. Fair value of NCI, 80. When you write it here, NCI will become credit. That's a double entry. So all these double entries, what I'm saying, it's there on the short note. Little bit, go and check your group. So guys, once again, once you get the fair value of NCI, what you need to do, copy it to goodwill. So when you copy, it becomes debit and the NCI working will become credit. So this is how, guys, we do paragraph number 1. So guys, I'm on the assumption that you have already studied consolidation. So I'm just revising these. That's it. Okay, right. Can you guys little bit check and see Roman number 1? Any doubts that you have, guys? Can you please clarify? Because this is a very good question. It covers all the basics, right? I mean, it covers all the adjustments, to be very honest. 90% of the lesson is covered through this question. So please check and see, guys, from the first paragraph, anything that you didn't understand, how it is marked or recorded, you can let me know. Right? Check and see it, guys, quickly. Okay. So guys, so far, no doubts. Okay, then guys, let's go to the next paragraph. Okay, check on this one and see, guys, you read. I will teach you how this is supposed to be done. Got it? You just read this. I'll teach you how this is done. Roman number 2. Okay. I'll just guys quickly go and bring a bottle of water. Right? Can you guys go through Roman number 2 and see? Exactly. At this level and in the next level, the share capital and the share premium, they will never speak about that. So therefore, it's always constant. So whatever that I wrote at the reporting is what we will always copy at the acquisition, because it always remains the same. At FA and our next level, FR. SBR, it might change, but most of the time, because they don't talk about it, these two are always the same as per the acquisition date. Okay, right. So guys, you go through this part. I'll quickly bring a bottle of water and come. Okay, right. So guys, Roman number 2, what does it say? At the date of acquisition, the fair value of Starboard approximated to its carrying amount with the exception for a plot of land. This land was recorded in the financial statements at cost 150, but the estimated fair value is 180. The land is still owned by Starboard. Okay, normally guys, what happens is this. Now, when we want to buy a company, first thing guys, what we will do is we will have to value the company. Okay, first of all, to buy a company, we need to value the company. So during the valuation, we will be sending in professionals to do that. So during the valuation, guys, sometimes we understand the value of some assets and liabilities which are shown by the subsidiary are actually worth more in the market currently. Okay, so those are what we call, guys, fair value adjustments. So first of all, guys, remember in our syllabus, we only have fair value adjustments for non-current assets, for FA. In FR is where asset value will go up or go down. Liability value can go up or go down. That's in the next level. At the foundation level, fair value can only happen for whom? Non-current assets. Fair value will only increase because, guys, in our syllabus, only we have revaluation surplus. No? Only the fair value will increase. It will not decrease for FA. Okay, at the FA level, fair value adjustments is only for whom? Non-current assets, and it will always increase for the foundation. Next level, things will change. Okay, anyway, So let's say, guys, I send in someone, I start valuing assets and liabilities, and then I realize that there is a land which is actually worth more than what they are showing. So see, in this paragraph, they are telling in Starboard's account, who is subsidiary, the land is costing 150. But their market value is 180, meaning, guys, the value is more. So now we need to account for this increase. So the land is 150, it became 180, the fair value is 180. So that means, guys, it has gone up by 30,000 rupees. Okay, so now we are going to learn how to adjust for this increase. So this is how, guys, you are going to do fair value adjustments. Step number 1, fair value adjustment, you should mark it in working number 2. So go to working number 2, right over here, fair value adjustment, right? So guys, how much has the land gone up by? See, guys, the land is 150, but it has gone up to 180. So the land has then gone up by 30,000 rupees. So therefore, guys, you write it here at the acquisition date. Done. Why do we write it in the acquisition date? Because it happened at that date. Here, guys, look at this once again. At the date of acquisition, it happened at that date. The value went up at that date. That's the reason why we are showing this under the acquisition column. And the same answer, you should also show it at the reporting column. Why should we show it at the reporting column? Simple. The reason why you have to show it at the reporting column is, guys, because that land is still with us, right? That increase needs to be shown in the financial statements. It has to be reflected there. That's the reason why we are marking in the reporting also. So guys, again, understand, why do we copy that under acquisition? Because it happened on that date. Why do we copy the same thing on the reporting also? Because this land is still with us. The increase needs to be reflected on the statement. It has to be shown over here. That's the reason why we are marking in reporting also. Right, now, guys, understand the double entry. When you write it here, goodwill becomes credit. Now you must be thinking, when we write it over here, how can the goodwill become credit? I'll show you that part. Don't worry. So just understand, when you write it here, guys, what happens? Goodwill becomes credit. Right? You don't have to worry about the credit part. You just copy it there in your exam. And then what is increasing? The land value is increasing. Land is part of property. So therefore, guys, now what you need to do, you have to increase your property by 30,000 rupees. Okay, so first thing, guys, what you do, you copy it over here. Right, so guys, there are two questions being asked, guys. I will explain to you all that one. So first, then, guys, you have to copy it in property, plant and equipment also. So once you mark it in property, plant and equipment over there, the increase needs to be reflected. Okay, so since the land is still with us, we are, guys, showing it over here also, property, plant and equipment. Right, yeah. So first question, guys, that is being asked, guys, over there is it a revaluation surplus? Very similar to revaluation surplus. It is revaluation surplus, but the thing is, we don't call it as a revaluation surplus. Okay, we just go by the name, but you can say fair value adjustment. It's basically a revaluation surplus, but we don't name it that way. We just go with fair value adjustment. That's the name of that's the name that we use, but it's exactly a revaluation surplus. If the land is, second question, what is the land is not with us? Number one, that will never happen at FA. It will happen only at FR. But once again, just to clear your doubt, if the land is not with us, then at the reporting period, you have to mark and show over there minus 30,000. Okay, if the land is not with you, if the land has been sold, then when you're preparing the account, this 30,000 is not in your book. No, so then you have to mark it and show as minus 30. Here, because the land is with us, we have to show this in our financial statement. That's why it's plus. If the land is not there, if it has been sold, then we'll mark it here minus 30. But again, guys, that will not happen at this level. It will happen at the next level. So anyway, the fair value adjustment, guys, quick recap. This is how we are going to do. Copy it in both the columns because it happened at this date and the land or the asset is still with us. So therefore, it should be reported. Since the property value is increasing, we are going and also adding our property. So when you write it here, what happens? Goodwill will become credit. Then where is the debit here? Property value increases. So therefore, guys, PPE should be added by 30. This is how you do all fair value adjustments for consolidated accounts. Copy it in both the places and go and add to your property. Right, just check and see, guys, any doubts that you're having over there. We'll clarify and then we'll move to the next adjustment. Okay. So guys, don't worry, we'll do more questions right now. You saw, right? Last Monday, we did how much? We did almost 4 full questions on financial statement like that here. So guys, as much as possible, we'll try to do the questions and, practice consolidation. Okay, now guys, I think y'all are okay with that part. Now guys, can you look at this last adjustment, guys, of the paper? Just read this. I will explain what you're going to do. Okay. Right. This part, guys, over here, Roman number 3, just read that. Okay, done reading, guys. Okay, now let me explain. Number 1, during the year, ports sold goods to starboard for 50 and 60% has been sold. Okay, now guys, always understand when one party sells goods to another party, parent is selling goods to subsidiary with a profit, or subsidiary is selling goods to parent with a profit. And if those stocks are left inside the business, see guys, now in our case, parent sold to subsidiary by keeping a 25% profit, and 60% has been sold, meaning 40% is still left. So understand, when one party sells goods to another party by keeping a profit, and if those goods are left inside the warehouse, then that means the examiner is asking us to do unrealized profit adjustment. Are you clear with that part? Okay, so that's how you should know which adjustment. Selling stock with a profit, and if those stocks are left, not the entire thing, if a part of it is left, that means it calls for us to do an unrealized profit adjustment. So unrealized profit, guys, has 2 parts: calculation part, then the double entry part. So I will explain both. So now, number 1, guys, how do we calculate URP? It's like this. First, you calculate the profit, multiply this one by inventory held. This is what you need to do. Profit multiplied by inventory held. Now to do the profit calculation, guys, we need to use a small formula this way. Profit is equal to selling price minus cost. Right. Now, guys, look at the way that I'm doing. You can send in any doubts that you have. Now, guys, see, port sold goods to starboard for 50. So sold goods for 50 means 50,000 is selling price. By keeping a gross profit margin of 25%. So the profit is 25%. So I'll mark it on top here, 25%. Okay, now guys, understand there are 2 ways of keeping profit. One is called a margin, which they have used in this question. There is another one method called markup. In the next question, when markup is there, I will teach you the markup part. For the time being, you just focus on the current adjustment. But if you want markup also, I'll tell you what is the change. Okay, maybe I can cover. Okay, anyway. Now guys, let's focus on this one. So there are 2 methods. The organization is using what? A margin. So please understand, if it's a margin, the selling price is always considered or assumed as the 100% factor. Understood? If you are using a profit margin, selling price is always assumed as 100%, meaning the cost is 75% in my case. Why? 100 is selling price, Profit is 25 means the cost has to be the difference, no guys? So it's 75%. Right, now guys, let me also teach you what if it's a markup. Simple. Guys, again, see, if it is a markup, what will happen? Still profit is 25%. If they tell there is a markup of 25. So still profit is 25%. But then what happens? If it's a markup, the cost will become the 100% factor like this. Now, if it was a margin, who is the 100% answer? If it's a margin, 100% person is selling price. Cost is the difference. Whereas if you're using a markup, it's the cost that's the 100% factor, meaning our selling price will then be equal to 125%. How 125%? Guys, again, basic math. From this, if you subtract 100, it's 25. So it has to be 125 now, guys. So this is if it's a markup. This one is margin. So now, guys, we are currently focusing on margin. So we'll take that. Just give me a minute, okay? Okay, right. So now, guys, again, this is a margin. So let's forget about this for the time being. It is not relevant. Okay. Right now, guys, let's focus on our one. Okay. So 50,000 is represented by 100. So divide by 100, multiply by 25. Now, if someone is thinking why we are multiplying by 25, guys, again, listen. What is the adjustment name? URP. To do the URP for speed, profit, no, profit is 25%. No, that's why I'm saying 25%. No need to work out 75. Don't waste time. You don't need to waste your time. Okay, don't need to work out 75%. Just work out 25% because I need only profit. Right now, guys, when you work this out, our answer is going to be, check and see, guys, how much is that one? 50,000 divided by 100, that into 25. Guys, I am getting 12,500. So this is the profit. Put it over here. Multiply this one by inventory held. Now, guys, can you read the paragraph and see what they are telling? 60% has been sold. Guys, I want how much is held, how much is left. So 60% is sold means how much is left, guys? How much is left? Very good. 40% is left. So therefore, guys, what you do? Multiply this by 40 and take. Very good, guys. There you go. 40% is left. Super. Right. So therefore, guys, 12,500. Now you multiply this by 40%. So therefore, guys, my URP is 5,000 rupees. My URP is 5,000. That's it. Right. Now, guys, I said you, when it comes to URP, there are two parts. Calculation part, double entry. So now I am done with the calculation. Okay, so little bit check and see, guys, are you okay with the calculation part? Any doubts that you have, please ask. Then I will teach you the double entry. Okay, just go through and see, guys, whether you are comfortable with how. And remember, guys, one thing, definitely URP will come. Whether you are doing income statement, whether you are doing SOFP in the exam, URP will definitely come. So this is something like we can guarantee in the exam. So please make sure that you're very comfortable with these adjustments. Okay. So my answer is 5,000. So any doubts, just drop a message. Okay. Now the double entry. Now, guys, the double entry will differ, slightly differ. It all depends on who is selling to whom. Now, to be very honest, there are multiple ways of doing this URP. I'm going to go by the method that I always use. Okay. Now, guys, it's like this. The double entry will depend on who is the seller. Whether it's the parent who sold the goods or whether it is the subsidiary who sold the goods. It will always depend. So what you should do is something like this. Now, question, one party is selling, so I'll teach you the double entry. Next question, I think it's changing, so then I'll teach you the other aspect of it also. So we'll go slowly. Right now, guys, here what's happening? It's the parent, port, who is the parent, is selling. So guys, remember, if the parent sells to subsidiary, what you should do, number one, inventory will become credit. Okay. So once again, guys, if the subsidiary sells this to the sorry, my bad. If the parent is selling to subsidiary, the 5,000 double entries, inventory becomes credit. So we go to inventory and reduce 5,000, right? So guys, why are we reducing from the inventory? Guys, listen. The inventories are kept at a higher price. So we want to reduce the profit. We want to now the purpose of the unrealized profit is, guys, we want to remove the profit. So because we want to remove the profit only, we are subtracting from inventory. Then inventory will become credit. And who is the seller? Parent. So guys, understand, if parent is selling, parent now earns this profit. Our objective is to remove the profit. So if you want to remove the profit, what you need to do? Parent keeps all his profits inside retained earnings. So therefore, guys, retained earning will become debit, or you have to subtract from your retained earning 5,000 rupees. This is how the double entry will work if the parent is selling to subsidiary. Once again, you got the answer, no? Ask yourself, who sold? Parent sold. So if the parent sells, number one, remove this from inventory. Inventory will become credit because we want to remove the profit. Unrealized profit purpose is removing the profit. So inventory should be minus, credit. Now guys, who is the seller? Parent. If parent is selling, parent now makes profit. If the parent is making profit, he keeps it here in retained earnings. So what's our objective, guys? Our objective is to remove the profit. That's the reason why retained earning becomes minus, meaning debit. So this is how the double entry would work if the parent is the seller for the URP. Inventory credit, retained earnings will become debit. Exactly. The reason why we are removing it from the inventory because because we sold it to the subsidiary is now keeping the inventories at a higher price. Now our inventory, when you give it to subsidiary, inside this 80,000, that inventory is there at a higher price. So from that also we want to remove the profit. That's the reason why we are removing that from the inventory. Okay. Now our stock now we sold. So here the stock is held at a higher price. So we want to remove that. That's the reason why we are subtracting from inventory, because it contains the profit. Correct. Okay. Got it. Super. Okay, guys. So that's how the double entry works. So what's the double entry, guys? Again, inventory becomes credit and our retained earning will become debit. Now, guys, next question I'll teach you. What if it happens the other way around? Meaning subsidiary sells to parent. How does it work? A small change will happen. I will explain that at that time. If not, it will be too much for you all for the revision. Right. Next one, guys. Also, this is not yet done. Continue reading further. At the reporting date, Starboard still had to pay to port 300,000. Now, guys, what happened was this. Now, parent is selling some goods to subsidiary, no? So they have sold it on credit. So that means now they are telling Starboard subsidiary has to pay for port 30,000 rupees, it seems. It's due. This adjustment is what we call a current account adjustment or a current account transaction. What does that mean, guys? Current account transaction is where one party owes another party some money because of trading between subsidiary and parent. There is a trade receivable and a payable. This is what we call, guys, current account transaction. See, guys, because these two are trading, now it shows that Starboard has to pay for parent 30,000. So when one company has to pay money from another company, or when one company has to receive money from another company, we call that as current account transaction, where for one person it's a payable, for one person it's a receivable. So therefore, guys, in accounting, what do we do with these transactions? We eliminate. This is like a set off. Now, guys, in control account lesson, there is something called a set off, no? Where from one person we have to get money and we have to pay. What do we do in accounting? We cancel it off. Same like that, guys, in consolidation, when one person has to pay money to another person because of trading, we call that a current account transaction. Meaning for one person, it's payable. For one person, it's receivable. What do we do? Cancel it from accounting. How do we cancel? Go to receivables and subtract that answer minus 30. Go to payable, subtract that answer 30. So when you subtract from receivable, receivable becomes credit. When you subtract from payable, payable becomes debit. That's a double entry. Okay, so current account, guys, what you should do? Very simple. Subtract from receivable, subtract from payable. When you subtract, credit. When you subtract from here, debit. This is all what you need to do. So with that part, guys, now I have finished all my adjustments. Now it's time for us to answer the question, right? We need to now give all the final answers. So let's see, guys, how that is supposed to be done. Okay, now it's like this. Now, guys, you start completing your workings now. Working number 1 is finished. Now let's do, guys, working number 2 quickly. Okay, so let me show you how that's done. Add all these. Okay, this one, total it up vertically. 150 plus 60 is 210. 210 plus 10, 220, 250. Right, over here, guys, the answer is going to be 350,000 rupees. Here to here, no changes. And also, guys, one more thing, if you don't know how to do working number 2, total first vertically, then see the differences. Okay, from here to here, what happened? 60 to 60, no changes. 10 to 10, there is no change. 150 to 200, 100,000 increase. Okay. 30 to 30, there is no change. So therefore, there is a 100,000 increase over here. Right. Now, guys, what are we going to do with these numbers? So it's like this. First thing, guys, what you should do, number 1, this answer, the value at the acquisition date, you are going to copy it inside goodwill and show. Okay. Mark here minus 250,000 rupees. Now, guys, this is where it becomes credit. Okay. Over here is where it becomes credit. I mean, what credit? Guys, can you remember I was explaining to you all this one, guys, fair value adjustments? Like when the property value increase, like a revaluation. I said you, when there is an increase in property, I first said you to mark it here and here. No? And what did I tell you at that point? When you mark it here and here, goodwill will become credit. How? Like this. Look at this, guys. Now, when you mark it here, that answer is inside this 250. No? Do you agree with that part? This 30 is inside this 250. Understandable? No? This 250 now goes inside goodwill, but as a minus value. Goodwill is an asset. When an asset is minus, that means the asset is reducing, meaning that's credit. That's why we say goodwill will become credit. Not directly, indirectly. When you copy it here, it goes to this total. This total is then taken to goodwill and subtracted. So once you subtract, what happens? Goodwill will become credit. That's why I said you at that point, goodwill will become credit. This is how it's done. And the property will become debit. This is your double entry. So guys, when you learn consolidation with the double entry and if you understand how it's being applied, you will never forget consolidation. It will always stay in your mind. So that's how the goodwill credit part is done. Okay, then guys, this 350 has nothing to do with our workings. We just keep it for the sake of it. 100,000, this is what we call, guys, post acquisition. That means from the time that we bought to the time that we prepare the statement, it has gone up by 100,000. Now, what you should do with this 100,000 is, here, guys, can you see my short note? Split between the parent and NCI. Always remember, in the post-acquisition column, if there is a value, you have to split that between the parent and the NCI. How to split that part? It's like this. Split it between parent and NCI. You split it according to the ownership percentage. That means the group structure. Parent owns 80%. So for the parent, you should give 80% of this. Subsidiary owns 20%. Sorry, NCI owns 20%. So you should give 20% to NCI. Okay, now guys, calculate. 100,000, 20% is 20,000. This goes to whom, guys? This goes to NCI. NCI means copy it here and show. Non-controlling interest post-acquisition reserve 20,000. That's your answer. 100,000, 80% will go inside retained earnings. Okay. 100,000, 80% guys will go inside retained earning. Meaning it's like this. Now 80% guys goes to parent. No. 80% is guys going to parent means there isn't a working called a parent working. Now it's like this. Normally what I have understood among students is that when I say 100,000 goes to NCI, they will remember. There is an NCI working, so we can go and mark it here. When we say 100,000, 80% you give to parent, people forget. Why? Because there is no parent working. So if you ever forget, just do it this way. Take this 80,000. Ask yourself, from where did this come? Now this 100,000, if you put 80% answer is 80,000, that's for parent. Where to mark? Think. 100,000 came from where? Retained earning. Therefore, guys, you should go and mark this inside consolidated retained earnings, working number 4, post-acquisition reserve, which is 80,000. That's how it's supposed to be marked. Take the 100,000, always post-acquisition is split between parent and NCI. NCI share will always go to NCI working. Parent share will always go inside retained earning. If you ever forget, it's very simple. Ask yourself, from where did this come? It will always come from retained earnings. So because of that, you are going to go and mark it over here. Done. That's it. So guys, this working now fully done. Now let's do goodwill. How to do goodwill? Simple. 300,000 plus 80,000 will become 380. 380 minus 250, guys, answer will become 130,000. This is your goodwill. Once again, guys, for students who don't know what's goodwill, it's like this. Goodwill is the premium price we are willing to pay to buy someone. Now, let's say, guys, for an example, normally, how do you buy companies? First, you have to value the company. So let's say, guys, I am A. I want to buy company B. So first of all, I need to value company B. How to value company B? You take their assets, subtract their liability, and then you can understand the value of the company. So let's say value of the company is 10 million. Now I offer 10 million to buy this company, but these people are telling, no, we want 12 million if you want the company. So now I argue with them telling that, no, your assets minus liabilities are only worth 10 million, but why are you asking 12 million? You're asking more than the worth of the company. So they will tell, our location is good. Our business has been in the market for a very long time. We have a strong customer base. We have intangible assets, skilled employees. We have a good market share. Like that, guys, they will state several reasons and they will ask for something more than the actual worth. If you are willing to pay, then that extra 2 million is what we call goodwill. Goodwill is the difference between the asking price and the actual worth of the company. If you are willing to pay the extra and get that extra, what you are willing to pay is called goodwill. Premium that you pay when compared to the value of the company. So in my case, goodwill is 130. Right, guys, remember normally goodwill is shown over here. Right, working number 3. And also, guys, one small thing I forgot to mention during my explanation is that when you write investment over here, now guys, in my goodwill working, I start off with investment. Now, what's investment? How much did the parent pay to buy the subsidiary? When you write the investment here, you should remove that from the investment from your SOFP. Now, in our question, they didn't ask us to do that, but I'm just telling for your additional knowledge when you do the exam. Here, guys, I mean, if you didn't understand that part, here it's like this. Here, guys, see. Now, in my question, I have an investment of 300,000. Usually what we do, we just copy that to the SOFP, 300,000. Now, guys, remember one small thing. This will be useful when you go to your next level or maybe even MCQ questions in our exam, is that, look at this part, guys. When you write investment here, Now you wrote 300,000 here because that's what they paid to buy the company. Make sure from your SOFP, you eliminate that investment. Now guys, don't misunderstand. Some people, when I say this, they always think this full thing should be removed. Not like that. Guys, now in our SOFP, how much was the investment? 300,000. If it was 500,000, I'll write here 500,000. You should always remove the investment amount, what you paid to buy the subsidiary. In my case, my investment and what I paid to buy the subsidiary is same. But if this was 500,000, I will still remove only 300,000. So please understand, what you write in goodwill as investment, that amount, when you copy it here, it becomes debit, goodwill debit. And the investment needs to be credited or removed. So you should only remove what you write here, not the entire thing. If this was 1 million, I would have removed 300 and kept 700 balance. So please don't misunderstand what I'm saying. You should only remove the investment that you write in goodwill. What you write here, you remove it from here. Right. So guys, the goodwill will go to SOFP here, goodwill working. Right. Next one, guys, consolidated retained earning. I am missing something. Now, what is, guys, consolidated retained earning? Consolidated retained earning means the retained earning of the parent plus the share of subsidiary. Okay, consolidated retained earning means the retained earning of the parent plus his share from subsidiary. So here, guys, normally in working number 4, which is consolidated retained earning, you first need brought forward of the parent. So brought forward of the parent, I have given within brackets Q. What does that mean? Brought forward of the parent, you should take from the question. So you go to your question paper. This is the retained earning. I want whose retained earning? The parent. Focus on the word. Brought forward of parent. So retained earning, this is the brought forward of the parent. This is subsidiary. So mark 295. Right. Now, guys, when you close this working, final answer will be how much? 295,000 plus 80,000 minus 5,370. That's it. Now, guys, close this working. Answer will be 100,000. Right. Guys, just spare me a minute. Okay. Right. Now, guys, if you're doing the full question, what you need to do, this retained earning, guys, you have to copy it over here, 370,000. Okay. And then, guys, non-controlling interest, 100,000, you have to copy it here. Right. Now, guys, let me do all these workings, then we can finish off this question. Right. So now, guys, once you're done with all the workings, now total these up because the examiner has asked us to do this. Okay. So once you total, guys, answer will be 350 plus 265 plus 30. Answer is 645,000. Here, guys, the answer 109 plus 80 minus 5. 184. Over here, guys, answer 79 plus 95 minus 30. 144,000. This is okay. This one, guys, 385,000. And here, guys, the answer 155 plus 60 minus 30, which is 185,000. Okay, now, guys, let's check and see what are the options that we have to answer the question. Okay, look at the first thing, guys, what they're asking. Right. Select the formula which correctly calculates goodwill. Now, guys, in our paper, they are not asking goodwill, but they are asking the formula on calculating goodwill. Now, guys, to calculate goodwill, this is the formula what I use. No. Right. Can you guys, in your mind, select the correct answer for this question over here, what they have asked, task number 1? Okay. To answer task number 1, they are asking what is the formula for goodwill. So these are the numbers that I used. Try to see, guys, whether you're able to get a correct answer for this option quickly. I'll give you a minute. See properly and get the answer. Okay, done, guys. Were you able to find the correct answer? So what should be the correct answer, guys? Correct answer has to be very good. Yes, very good, guys. So both the students who sent me the answer, guys, that's correct. That's the correct answer. So guys, see, for you to get the answer, you have to do the working. If not, you won't know, right? So that's the reason why I took a lot of time, showed all these structures, because in the exam, that is what we need to do, right? Other students, your answer is, guys, 2. Because see, 300,000 plus 80, everything has that 380, everything has the option. Then we subtracted 250. Now, guys, how did we get 250? 60 plus 10 plus 150 plus 30. So 60 plus 10 is what they mention here, 70. This 150 is this 150, this 30 is this 30. So everything added and subtracted. Right, next question, guys. How do you classify goodwill? 3 options: tangible non-current asset, current asset, intangible asset. Guys, listen, goodwill is something that you can't see. It's intangible. So therefore, guys, answer has to be intangible non-current asset. It's not a tangible. No, it's a current asset. It's an intangible asset. That's why now, guys, we are writing it in between here. See, between non-current and current, now we are showing goodwill, meaning that's an intangible asset. Right, now, guys, look at the next question, what they're asking. What are the values of, right, property, inventory, trade receivable, trade payable, bank loan? What are the values? Here, guys, can you see these things, what I found here? PPE after adjustment 645, inventory after adjustment 184, trade receivable 144, bank loan this and this. So you just have to combine with the adjustments and show the answer. That is what we need to do. Okay, then, guys, let's go to the next part of the question. What would be shown in the goodwill? What is the amount for non-controlling interest? Here, guys, non-controlling interest, what's the answer? 100,000. What is the amount that should be shown for retained earning? Here, guys, can you see working number for retained earning is 370,000. So those are the answers for the question. So it's almost 80% of the question must be done fully, like how you know, like in a classroom when we do the question fully, how it's done. Like that, guys, at least 80% you need to do in order to find these answers. Right, now, guys, over here they have asked 2 questions. One is associate. Associate, guys, I'll touch on it during the last class of the revision, which is the 4th week. And, guys, ratio over here, I think ratio is something that you can manage. We'll focus mostly on consolidation. Okay. Right, now, guys, we will start another one question over here. So next week, guys, I'll be teaching you all consolidated income statement. So today's focus is fully going to be consolidated SOFP. Next week, consolidated income statement and associates, we can look at that next week. Yes, guys, definitely. I'll give you all a break. Okay. Last week, guys, I think I gave it roughly around 7:20 or no, so same time I will give, right? Then we will be, guys, able to perform the Isha prayer also at the same time. Yeah, sure. 1 minute. Wait, huh? I'll clear the screen, then it will be easier for you. You can go ahead. Done. Okay, super. And also, guys, remember I shared a document called F3 exam kit, right? So in that exam kit, guys, these questions are all there, what I'm practicing. Okay. Right. Now, guys, then we'll try to do, guys, this question over here, which is push and shove. So it's a question where, guys, they are asking from us, number one, calculate the goodwill. Then, guys, on the other hand, they are asking to show a double entry for some share issues or something like that. Then they are asking calculate consideration paid, calculate the retained earnings. Then they are asking guys us the value of non-current asset, current liability. So it's kind of a little bit of a bigger question actually. Then they are asking from us non-controlling interest value. And top of the non-controlling interest value, guys, they are also asking us the value for the retained earnings. Okay. So it's almost as if they are asking the entire question from us. Okay. So therefore, guys, we will then quickly copy down. I mean, I think we need to do, guys, the entire thing over here. So so this time, guys, they are asking directly like this. What is the value of the non-current assets? So meaning this one. So guys, this question also, guys, there's a lot that we can learn. Like things that were not there in the last question, like, mid-year acquisition. Then for an example, share exchanges. So those are things that we can learn. So a little bit of a tougher question, but I'll do it because, guys, I feel you can learn a lot from this question. Okay. So guys, now you understand, right? So once I go through the requirement, they're asking non-current assets. Current assets, current liabilities. Now, normally, guys, assets and liabilities, how do we normally deal with the consolidation? I thought, guys. So normally assets and liabilities are dealt this way. Okay, so normally if it's assets or liabilities, what do we do, guys? Parent plus subsidiary. Understood? So whenever they ask you what's the value of a non-current asset or a current asset or a non-current or a current liability, all what you need to do, parent plus sub, add it with the adjustments. Okay, so let me do that first. So they're asking non-current asset value. I have property, plant and equipment. So let me add that one, guys, over here, which is 40,600 plus 22,000. 22,600. Okay, then guys, on the other hand, current assets. So all the current assets are shown at once, 16 plus 16, 6,600. So current assets, 16,000 plus 6,600. Then guys, on the other hand, what they are asking, current liability, 8,200 plus 4,700. 8,200 plus 4,700. Done. Okay. Now, guys, then let's start the question what we are doing. Okay. Now, guys, first of all, in your mind, can you guys quickly understand the group structure? They bought, the question is finishing on 30th of September 2008. Right. Can you guys just read this part over here and on your own, can you quickly decide for me who bought whom, what percentage, is it a full year question, is it a half a year question, like that, guys? Can you quickly decide on your own, guys? I'll give you like a minute time, right? Quickly decide on that. Okay, done, guys. So see, this question is ending on September 2008. So guys, understand, if the question ends on 30th of September 2008, when does the question start, guys? Then the question will start on 1st of October 2007. So that's the date in which the company was bought. Can you see, guys, on 1st of October 2007? That means when the financial year is starting is where we bought. Meaning, just like the earlier question, no changes, right? The company was bought at the beginning of the financial year. So therefore, guys, your group structure will now work this way. So I will update it on my sheet over here. So what happened, guys? Push acquired how much percent? 60% of Shub. Okay. So that means there is a 40% NCI. And this is a full year subsidiary, just like our last question. Okay, it's a full year subsidiary. Okay, now guys, can you read this and say, guys, what's happening over here now when compared to last time? There's a small change. Okay, so continue reading. I'll teach you how to do it. Okay, just continue reading. Okay, so what does it say? By going for a share exchange. Now, guys, listen, at the foundation level, you can buy company in two methods. When you buy another company, guys, you have to make a payment. So the payment can be done in two methods. Method number one, paying money. That's what happened in the last question. In the last question, Port paid 300,000 to Starboard to buy the company. That's one way. Second way of buying the company is share exchange. Parent, who is the big company, will give shares in their company and buy the small company. Now that's what now guys happened with Dialog and Airtel. Well, recently you would have seen that Dialog acquired Airtel. How did they acquire? By giving shares. Dialog in their main company, they gave ownership. They gave shares to Airtel and then they acquired the Airtel company. So that happens. And people are happy because normally, guys, when they go for a share exchange, you get shares of ownership from a bigger company. So you become an owner of a bigger company. So people will like that. So that's what happened over here. Push, who is a big company, gave shares in his company and then he bought the subsidiary. So they went for a share exchange. So normally, guys, when you go for a share exchange, this is the formula that you should use to find the value. So normally, this is what I teach in the theory class, right? So if you go for a share exchange, right, how to calculate the value? This is how, guys, the value should be calculated. Number of shares in subsidiary multiply by percentage acquired. Okay. That you multiply by the value per share. This is what you need to do. Okay. Multiply this one by the value per share. So normally, guys, if you go for a share exchange, this is the formula that you should use in order to find the answer. So first of all, guys, can you copy down this somewhere if you want? And can you try to use this formula and try to get the value, guys, if possible? And also, guys, sorry, I forgot to update. Number of shares in subsidiary multiply by the percentage acquired multiply by value per share that you multiply by a ratio. So normally, guys, in a question, they will always tell we issued this much shares for this much, 4 shares for 5, 10 shares for 10. Like that, they will also ratio. So there's a ratio also involved over there. So copy down this one. If possible, can you guys try to substitute the values for this formula? I'll give you a minute. Just try and see. A minute. Let me check that answer. Hmm. Okay, and not a problem at all, right? So the important thing is that you have tried. Okay, right. Okay, let me guess little bit check on that answer. So it's like this. So first one, number of shares in subsidiary. Okay, now guys, normally how do we find the number of shares in subsidiary? Like now these subsidiary, shares are these. So what you do, 4,000 divided by 1. Guys, don't take this answer directly. Now today when you take this answer, it's okay. You are safe, but don't do that in the exam because I'm asking guys number of shares. This is $4,000. That means the value. I don't want the value. I want the number of shares. So 4,000, one share is $1. So 4,000 divided by 1, we have 4,000 shares in subsidiary. Multiply by percentage acquired. So how much have we acquired? 60%. Multiply this one by value per share. How much is per share at the date of the acquisition? Push had a fair value of 6. So multiply by 6 and that into the ratio. I think this is slightly confusing. Let me explain. Guys, see, in exchange for 5 shares for 6 shares in Shove. What does that mean? Parent will give 5 shares in his company provided you have 6 shares in subsidiary. Once again, parent will give 5 shares for every 6 shares in subsidiary. That means, guys, 5 over 6. See, in exchange for 5 shares, so multiply by 5 for 6 shares. So divide that by 6. Multiply by 5 and divide by 6. So this is the answer, guys, that you need to get. 4,000 into 60%, that multiplied by 6, that into 5, divided by 6 again. So therefore, guys, based on this, what is the answer, guys, that you will be getting? Exactly 12,000 should be the answer for the share exchange. Right. Okay. So guys, now what we will do after we copy 12,000, guys, now let's go for a 20-minute break. Now it's 7:25. So 7:45, guys, again, we will resume the class after the prayers. And then I will explain to you how to mark this 12,000. And also, guys, if anyone didn't understand how the 12,000 came, you can let me know. Right. Okay. Now, guys, let's have a break and come back at 7:45, guys. We'll resume the class at that point. Okay, right. So guys, then let's resume after the break. So as we were guys going for the break, we did a small formula and we got the answer as 12,000. Okay, we did the formula and we marked it as 12,000, or we got the answer as 12,000. Now guys, this 12,000 is what we call a share exchange. Now, if the company does go for a share exchange, the double entry would be like this. Share capital will become credit and no, not share capital. Okay. Yeah. Now, in this case, guys, we can go with share capital because, guys, there is no share premium on the question. Okay. Now, in this question, guys, over here, there is no share premium. No. But correctly, if we are doing, it will be like this. Right. So first I will wait, shall I directly explain the correct thing once and for all rather than going for shortcuts? Yeah, we'll do it this way. Okay, now see. Now guys, we got the answer as 12,000. No? So correctly guys, if you are doing, it will be like this. Number of shares in subsidiary, multiply that one by percentage acquired, multiply that one by first nominal value. That one guys, you multiply by the ratio. And then guys, once again, guys, you have to do the same thing. Number of shares into the ratio, but this time rather than nominal value, we are going to multiply this with the premium value. Okay. So the working guys will go this way. Number of shares 4,000. Here also 4,000. Percentage acquired 60%. Here also 60%. Multiply by nominal value 1, here premium value 5. And then guys, the ratio will be none other than 5/6. Here also 5/6. Now, before the break, when I'm explaining, I directly went with value per share. So it makes your work easier. So here guys, they are telling value per share is 6. No? So we directly multiplied it with 6 and we got the answer. There is another one way to do it, guys, like this, breaking it into nominal value and premium value. Now, if you want to understand how did we get nominal value 1, how did we get premium value 5? Here, guys, can you see the equity share is $1. This $1 is the nominal value. What is nominal value? Nominal value is what we call, guys, the minimum value of a share. So normally the minimum value of a share, they will state in the question, this is how we got the $1, which is the nominal value. Now, what is premium value? Premium value means the difference between nominal value and market value. That's what we call premium value. The difference between nominal and premium. So here guys, see, nominal is 1. Market value is 6. The difference between 1 and 6 is how we got over here 5. So again, guys, when you do the calculation, here you will get 2,000. Here you will get 10,000, meaning the answer is 12,000 once again. Now, before the break, guys, what we did was like this. Before the break, we went at directly 6. Number of shares into the percentage acquired into value per share. I directly went with value per share, which is 6, rather than breaking it down like this. But normally, guys, if you check your textbook or study text or anything like that, they would have broken the share exchange into 2 parts, nominal value and premium value, where again 2,000 and 10,000 will again give you 12,000. So before the break, I directly went with 6. But now after the break, I'm just teaching you the proper thing where you have to divide as nominal value and premium value like this separately, 1 separately, 6 separately. 1 minute, guys. There are 2 doubts. Okay. Yeah, very good. That's exactly what I'm explaining. Super. Premium value. Yeah. So premium value is something like this. Premium value means the difference between the nominal value and the market value of a share. That's what we call premium. That means when compared to the nominal is minimum value, no? When compared to the minimum value, how much people are willing to pay extra. So the nominal value is 1, minimum. Market value is 6. The difference between market value and nominal value is what we call premium value. So that's how we got 5, where the answer is 12,000. Right now, guys, let me teach you how to do the double entry, because the paper said the issue has not yet been recorded by push. The parent forgot to record these. So if you do forget to record, how to pass the double entry, this is how the double entry will work. Now, why we are giving a share exchange? To buy the subsidiary. So therefore, guys, what will happen? Double entry will be investment account debit by 12,000, meaning plus 12,000. Then you're issuing shares, no? So therefore, guys, what will happen? Share capital will become credit 2,000. For those who don't know, normally in the share capital account, we always record the nominal value. So share capital credit means plus. Why plus? Guys, if you issue shares, the share capital increases. So therefore plus. And then, guys, on the other hand, share premium will become credit 10,000. Always remember, guys, in accounting, the premium value should be marked inside the premium account. The minimum value should always be marked inside the share capital account. So this is how the double entry, guys, would work, since the share issues have not yet been recorded by push. Parent omitted this. So if we are to pass the double entry, investment account debit, because you are buying a subsidiary, it's an investment. Because you are issuing shares, share capital and share premium will be credit. So guys, remember, now the accountant forgot to mark. No? So if I am updating my question, it will be like this. Here in my question, I will show investment. Now, who did the investment? Parent. And parent now, guys, forgot to mark this. So I will write here 12,000. Share capital credit by 2,000. So go to shares and credit this by 2,000. And then on the other hand, guys, over here, share premium. Now there is no share premium. No, so I'm going to create one. Share premium will become credit by 10,000. So this is how the accounting entries are passed and updated, because parent forgot. Guys, listen, I have seen so many exam kit questions where when they go for a share exchange, they forget. So when they forget, there is a double entry. Investment, create one. Share capital is there, update. Share premium is not there, so create. So like this, guys, at least in your mind, these should be updated, because you're doing a computer-based exam. At least in your mind, you need to update this way and keep. So this is how, guys, the first adjustment needs to be done. Okay. So if I'm doing my goodwill, I will write here investment as 12,000. Okay. The investment what we made over here, guys, I'll be writing over here 12,000 if I'm doing goodwill. But in my paper, they never ask the goodwill. So therefore, I don't have to worry about this. Right, little bit check and see, guys. Are you okay with this part, guys, with what I have done so far? Any doubts, please ask me. Okay, so guys, no doubts been asked. So therefore, guys, and let us move to the next part then. So guys, for the time being, I'll just erase these small things. I'll keep the rest. And also, guys, over here, I should add 2,000. Right, now, guys, let's go to the next part. At the date of acquisition, the fair value of the net assets were equal to their carrying amount. What does that mean? There are no fair value adjustments. Now, guys, last time they said everything was equal to the carrying amount except land. Can you guys remember the land value went up by 30,000? Okay. Now, today, guys, the land value is not increasing. Anything is not increasing. So that means, guys, in our paper, there are no fair value adjustments. Are you clear with that part, guys? No fair value adjustments whatsoever. Next part, Roman number 3. Push has a policy of accounting for non-controlling interest at fair value. The fair value in Shove at the date of the acquisition was 3.5. Consolidated goodwill has not been impaired. Guys, listen. For the foundation level, there is no impairment. Impairment happens at the second level, FR, not here. Okay, now guys, non-controlling interest. Listen, in your exam, non-controlling interest, guys, can come in 2 methods. The value of the NCI, either they will give it. Now, can you guys remember in the last question what I did? Port and starboard, in that question, the value of the NCI was given to us. They handed it over. But whereas, guys, in the current question, the NCI value is not given. So when the NCI value is not given, you can use this formula to get the answer. So what's the formula? Again, guys, number of shares in subsidiary multiplied by NCI percentage, multiply this by value of the NC, value of the subsidiary share price. Okay. Value of the subsidiary share. Value per subsidiary share. So in some questions, they will give the value of NCI. Some questions, guys, they won't give. So if they don't give the value of NCI, this is the equation that you need to use in order to, guys, find the NCI value. Okay, now, guys, can you quickly use this formula and try to find the NCI value for me, guys, if possible? Okay, please try to find the NCI value if you can. Use the equation. And most of the time, guys, they will go for this method only. Most of the time. Okay. Okay, right. Wait, let me quickly check that answer. Correct. That's the correct answer. Right. Good. Others also, guys, then little bit try to use this equation and, guys, find the answer for the fair value of NCI. Okay, so guys, were you able to do that one? Okay, now guys, can you check the substitution part little bit? So what happened? Number of shares in subsidiary. So guys, subsidiary company has how many shares? 4,000. 4,000 divided by 1. Don't directly take 4,000. Always in the exam, 4,000 divided by this. So 4,000. So 4,000 shares are, guys, there in the subsidiary company. So I'll show the working here. 4,000 shares multiplied by the NCI percentage. NCI percentage is 40%. This one, guys, you have to multiply by value per subsidiary share. The fair value of a $1 share in Shove, who is subsidiary, at the date was 3.5. So 3.5 per share. So therefore, guys, if you take 3.5 per share, what will happen? The answer will be, guys, 5,600. So if the answer is, guys, 5,600, double entry for NCI fair value is copy it here. NCI will become credit. Okay, when you copy it here, NCI will become credit, and copy this to goodwill. Goodwill will become debit. Again, guys, listen, in our exam, in that question, they are not asking the goodwill answer. I'm just showing you. That's it. Right. So this one they are asking. Non-controlling interest, they are asking. Retained earning, they are asking. Okay. What they are not asking is goodwill. So therefore, we don't need that, but I'm just showing you. So copy here, goodwill debit, NCI credit. Okay. So guys, then that part is done. Okay, now guys, then let me go down then. Okay, now guys, if possible, can you guys just try to do these two adjustments on your own? Now, when you read Roman number 4, you will understand it's URP. Okay, so normally guys, how do we calculate URP? URP is equal to profit multiplied by inventory held. So normally guys, for the profit, we have that equation of selling price minus cost. Right. So Roman number 4, I'll give you all a small hint. It's guys related to our URP. So try to find the URP answer. I will teach you the double entry. Then guys, Roman number 5, this is the same thing what we did in the earlier question. From your mind at least, try to guys work out what should happen, like whether to add or whether to subtract. Right. Can you guys then try these two and show guys over there, Roman number 4 and Roman number 5. Check the last question, same way only we are doing. URP. Wait, let me check that one. Okay, this time they are using a markup. I thought you all know guys markup in the earlier one. So remember, if it's a markup, this is 100% the cost. Okay, so see that part and guys then get it done, please. Yeah, correct. Your URP answer is correct. Super. Okay, right. Now, guys, let me explain to you how to do those two adjustments. So number one, guys, see sales by S to P. So this time, guys, subsidiary has sold to parent for 6 million. Okay, so guys, selling for 6 million means this is a selling price, 6 million. With a markup of 20%. So guys, remember 20% is the profit. Like I said you, if it is a markup, it is the cost. That's the 100% factor. So if cost is 100% and profit is 20%, guys, selling price is 120%. Right now, guys, you start working out. Now you want the profit, no? Then work out 20%. So therefore, guys, what you should do, 6,000 divided by 120. Multiply this one by 20. So 6,000, guys, divide by 120. And when you multiply by 20, guys, profit will become none other than 1,000. So put that here. Take it over here. Profit is 1,000. Now, guys, check the inventory held. 1/4 of these are remaining in the inventory. Okay. 1/4 remained in the inventory. So 1/4 is held. So see 1/4. Then, guys, the answer will become none other than 250. So this is the URP value. So if you have difficulties in the calculation part, guys, please do let me know. But I'll teach you the double entry because it's different. Right. Then, guys, on the other hand, number 5, at 30th of September, Shav had a receivable due from Push for 1 million. This agreed with the amount payable. So can you see, guys? S had a receivable. That means for one company, it's receivable. That means for the other company, it has to be payable. So this is what, guys, we spoke in the last question as current account transaction. Current account transaction means, so one company, it's a receivable, one company, it's a payable. What do we do with them, guys? We eliminate them. We eliminate them in the sense, number one, now for one company receivable, no, receivable is current asset. So guys, we should go and remove this from current asset minus how much? 1 million. For another company, guys, it's a payable, no? So therefore, payable means current liability. Go and remove from that 1 million, current liability payable. Right. Now, guys, an important part coming up. Now, I need to teach you the double entry for URP. Right. Now, guys, see, in the earlier question, right, in the previous question, it was parent who sold to subsidiary. Then for URP, the double entry was like this. Okay. Then the double entry was, okay. If the parent had sold to subsidiary, retain earnings, working number 4 becomes debit minus, and inventory becomes credit minus. Okay. Retain earning working number 4, guys, will become debit, and the inventory also will become credit. Done. Now, guys, remember, in our question, it is Shav who is selling to Push. So over here, guys, what's happening? It's the subsidiary who is selling to parent. If subsidiary is selling to parent, guys, still remember, in terms of the double entry, inventory will still be credit. Because, guys, our objective is to remove the profit from the inventory now. So therefore, guys, like earlier, still the inventory will become credit because we want to remove the profit from the stock that they have sold. So therefore, what I will do, inventory is part of current assets. Exactly. Always URP must be calculated for the profit that is remaining or for the stock that is remaining. So the total profit what we made was 1,000. But from that whole 1,000 worth of profit, only 1/4 of the goods is left in the inventory. Wait, guys, let me go through that one more time. Let me go through the adjustment. Yeah, 1/4 is remaining in the inventory. So like how you had asked me, always URP is calculated for the inventory that's left, inventory that's remaining. Okay, so that's how we always calculate URP on the inventory that is remaining. So the total profit was 1,000, but 1/4 is remaining. So 1/4 will become the URP. Okay. Right. So, okay, so again, coming back to what I was explaining. So I said you inventory becomes credit. So inventory is a current asset right now, guys. So you go to current asset and subtract from that one 250. Done. Okay. Now, guys, the next part. Adjusting the debit. Now, last time what happened? Retained earning became debit. Why did the retained earning become debit? Retained earning, guys, became debit because last time parent sold to subsidiary, no, guys. Okay. Last time who sold? Parent sold. So parent made the profit. Is that understood? If parent is selling, guys, parent only makes the profit. So parent keeps his profit here, no? So because parent keeps his profit here, we remove the profit from retained earning. Now, guys, what happens? Now, in our question, who is the seller? Subsidiary is the seller. So if subsidiary sells, subsidiary makes profit. Is that clear? If subsidiary sells, subsidiary makes a profit. Subsidiaries profits, guys, always will be split between parent and NCI. That's how, no, guys, it normally works. When subsidiary earns a profit, it will go as post acquisition. Post acquisition, guys, we always split between parent and NCI, no? So how it will be split according to the percentage. So parent will take 60% of the subsidiaries profits. NCI will take 40% of the subsidiaries profits in our question. Here, guys, 60 and 40. So then what we should do, we should remove this profit from these areas. These areas in the sense, from the NCI working, 40% of the profit has to be removed from parent area. What is meant by parent area? Parent area means, guys, from retained earnings, you should remove 60% of the profit. Because, guys, if subsidiary makes a profit, his profit he will share between parent and NCI. So he's sharing profit with the parent. Now, where does parent keep profit? In retained earnings. So remove 60% out of it. Whereas if the NCI gets the share, that share, guys, you have to remove it from the NCI working. So in terms of double entry, guys, it will be like this. Retained earning, working number 4, you should debit, which is minus the parent percentage. Then once again, NCI, working number 5 will become debit, which is minus, which is the NCI percentage. So earlier question, guys, parent is the one who sold. So parent will make profit. Where does the parent keep profit? Retaining. So remove only from that. But if the subsidiary is selling, it becomes little complicated. You think like this. If subsidiary is selling, who is making the profit? Subsidiary. When subsidiary makes a profit, he will give to parent the ownership percentage, or he will give to parent a percentage and NCI a percentage. So you go to these two areas. Parent area is here. NCI area is here. From those two areas, you have to remove the profit what they gave. This is how the double entry is done if the subsidiary becomes the seller. If parent becomes the seller, it's quite easy. If the subsidiary is the seller, this is what, guys, you have to do. So in my question, if I'm to like complete, it's like this. Now subsidiary makes a profit means he will give to parent 60%. No, so parent is here, working number 4. So you mark here URP. Right. So how much is the URP, guys? URP is 250, but put 60%. Only parent percentage must be removed. So 250, 60%, guys, will be 150. The rest of the answer, remove it from NCI. So you go to NCI, write there URP, 250 into 40%. So remove 100 from him. So this is how, guys, the working or the double entry is done if the subsidiary becomes a seller. There will be two debits here and here. You should remove the profit according to the ownership percentage. This is how it's supposed to be done. Okay, right. So there's a question being asked over there. Okay, then in that case, you will be doing like this. Now you had asked me a question. 1 quarter of 6 million is 1.5 million. So for 1.5 million, aren't we then you have to do it like this. In that case, what you said is true, like this. Then that's an alternative way. You take 1.5 million over here. So 1.5 million is the remaining inventory. So let's take the remaining inventory 1.5 million, divide that by 120 and multiply that by 20. So 1500, when you divide by 120 and when you multiply it by 20, still you will get 250. So here what I am doing, I am taking the full profit and then multiplying with the remaining inventory and getting the same answer. What you said is also correct. Rather than putting 6 million, only 1 quarter of the sale is remaining. So 1 quarter which is remaining is 1.5 million and directly see 20%. Then again, don't multiply by inventory held because you already took the remaining sale now. So in your method, if you are doing, you should only do this part. That's it. So you put 1.5 million as your sales and get your answer. Again, don't multiply by inventory held because you're already taking the remaining value now. It's correct. And still you will get the same answer of 250. Are you okay with that part? Super. Okay, right. So guys, now I have taught you guys if the subsidiary is the seller, how it will impact our financial statement. So if the parent is the seller, this is how the double entry is done. If subsidiary is the seller, guys, this is how the double entry is done. So just keep practicing, guys, this one by one, then you will be able to get this done. Okay, so guys, I think now the question, all the adjustments are over. So you can guys copy down these two if you are copying, and then let me move to the next part. Okay. Right. Then guys, moving on. So now I think we have guys done all the adjustments. Now let's see what they're asking. Okay. Now guys, first thing what they're asking is this. Number one. Now guys, now we're done with all the adjustments. So first thing they're asking from us, state the accounting entries for the issue of share by push. Right. Guys, can you remember I gave you the double entry for the issue of share? So what was the double entry that we wrote on the screen? Investment account debit by how much? 12,000. Then share capital credit by 2,000. Share premium credit by 10,000. So that is the answer, guys, what you should do here. Okay. So share capital 2,000 credit, investment 12,000 debit, share premium 10,000 credit. So the double entry only what they are asking as the first part of the question. Right. Second part of the question they are asking from you, what is the fair value of consideration paid? Guys, fair value of consideration paid is 12 million. Okay. That's the investment. How much did you invest on the subsidiary? So they are asking, select item number 1. So item number 1 is, guys, over here. Can you see? Right. Now they are asking from you, how did you get 12,000? Select the correct option. So once you select the option, it will get updated here. So they are asking from you, how did we get 12 million? Now guys, from out of all these options, how did we get 2 million? First we took 4,000. Then we put 60%. Then we multiplied that by 6. After that, we multiplied by 5.6. That's what now, guys, we can remember. Okay. To get 12,000, guys, that's the answer. Now we did take the subsidiary share, put the acquired percentage, value per share into the ratio. So this is the correct answer, Roman number 3. So this, if you select, it will get updated over here. Second question they are asking, what is the fair value of the NCI at acquisition? Here, guys, this one, 5,600. The value of the NCI at the acquisition date. Right. Next one, guys, they are asking from you. Okay, over here, this part. Now, see, this is how this is getting connected. Now, normally, guys, when we do in class, I don't know, when I do in class, what I normally do is I write minus net assets at the acquisition date, working number 2, meaning I get it from here. You saw, no, guys, last time how I got the answer, that same answer only, what they are asking here. So they are telling there are two components. Share capital. Okay, so that means, guys, over here they are telling one is share capital, it seems. And the other one, what they are telling is retained earning, it seems. So let me write it over here, then it's easy for me to explain. Okay, so guys, normally now this is actually, guys, goodwill, no? So how to get the goodwill? Fair value, which is the investment, value of NCI, which is value of NCI, fair value of net assets at acquisition, there's only this one, net assets at the acquisition date, meaning the answer over here. So they are telling there are two things. One is share capital, one is retained earning, and then retained earning, they are telling item number 2. Little tricky. So let's little bit go through and see, guys, item number 2 in our question. So they are asking, select the correct formula which correctly calculates retained earnings at the acquisition date. So they have given us 3 options. Okay, let's see what is the issue that we are having over here. Let's see. Okay. Right. Now, guys, again, one more time, I'll teach you how to do this area. Now, guys, again, it's all on the words. Read carefully. Net asset. Guys, what is net asset? Net asset means equity. How many components are there? 2. Shares and the retained earning. Now, there are so many values. No, don't lose focus. Net assets of whom? Subsidiary. Subsidiary is this person. No, guys. So you have to focus on these 2. Got it? 4,000 and 16,000 is on 30th of September 2008, meaning the day that we are doing the question. So therefore, guys, these are what values? These are reporting values, 4,000 and 16,500. These are the reporting values. Now, guys, I said you normally in the question, share capital, they will always give. Sorry, my bad. Share capital will never change. Normally, guys, at the foundation level and in the next level, it won't change. So therefore, guys, it's 4,000 as it is. No changes at all. But the retained earning at the acquisition date is not given. Can you see here, guys? Retained earning at the acquisition date is not given. They haven't provided us that answer. So we have to calculate that. Now, why I'm telling they have not provided the answer? Guys, when you read all these adjustments, have they spoken about the retained earning in any manner? No, guys, they haven't spoken. So they want us to find this answer. How to find this answer? There are 2 methods. There are 2 equations. To find the retained earning at the acquisition date, right? One thing, guys, what we can do is take the retained earning brought forward of subsidiary and add profit after tax. Or second method, take the retained earning carried down of subsidiary and subtract profit after tax. So normally, guys, these are the 2 equations that we use in a situation where subsidiaries retained earnings at the acquisition date is not provided. So guys, copy down this one, guys. I'll teach you how to do this one. Copy it down and keep. Okay, right. Let's start, guys, over there. Yes, exactly. That's correct. Retained earning carried down minus PAT will give you retained earning opening balance. True, correct. Okay. Now, guys, see, yeah, in this question, that's the one that you have to use. Good, super. Okay, now, guys, look at this question over here. Now, see, first, now, guys, there are two options. No, guys, know both the equations because you never know what can come in the exam. I have seen both. They are testing in the exam kit. Right. Now, see, retained earning of subsidiary. Now, guys, in my question, this is the retained earning of subsidiary. This is parent. This 35,400 is parent. You can't take this. So from the subsidiary, I just have one retained earning, which is 16,500. Now, it's up to us to decide, is that the brought forward or the carried down? Because there are two equations. So it's us. We should decide, guys, is this 16,000 the retained earning starting balance or the retained earning ending balance? Now see, this 16,500 is given for 30th of September 2008, meaning that answer, guys, what we have over there is retained earning carried down. So now I should go for the second option. It's retained earning carried down. Go for the second option. From this, if I am to get the retained earning at the acquisition date, again, guys, listen, if I understand that this is little complicated. Normally, when they don't give the retained earning, it's a little tricky. So this is what now, guys, happened in the question, right? Now, what happened is this. Let me draw a timeline and show it to you. Okay, see. Our question is ending on 30th of September 2008. Our question is starting on 1st of October 2007. Now, guys, 1st of October 2007 is the day where the question is starting and the day in which the subsidiary was bought. So in the exam paper, they have given 16,500, which is retained earning carried down, retained earning at the end of the year. Now, when you do this one, we don't want the retained earning at the end. We want the retained earning when they bought the company, which is retained earning at the start of the year. That is what we want. Okay. Retained earning at the start of the year. So therefore, guys, the retained earning at the start of the year, you do this and get your answer. Okay. So this is what is happening in the question. We bought the company at 1st of October, which is the start of the financial year. So we have to find the retained earning at this date. So to find that only, guys, I have given you the formula. Take your closing retained earning balance, subtract the profit after tax. So in our question, guys, profit after tax, we have to find. Let's go to the previous page. Now, guys, when I go to the previous page, there are two profit after taxes. Here, guys, can you see? Profit for the year, 7,000, 4,000. Guys, listen, don't lose focus. We are doing this one for whom? The subsidiary. Working number 2, guys, we are doing for subsidiary. No, so subsidiary's profit after tax only must be subtracted. So therefore, guys, from 16,500, you deduct 4,100. So once you deduct 16,500 from 4,100, guys, your answer has to be 12,400. 12,400 should be the correct answer. Okay. So now, guys, we will be able to select our option now for the paper. Okay, let's go down, guys, on this part over here. Okay, let's go down on this part. So what does it say? What's the equation? Right here, guys, can you see? So how did we get this 12,400, guys? 16,500 minus 4,100. So this has to be the correct option. 16,400 minus 4,100. So this is the answer. So little complicated. Okay, so always remember, guys, if they don't give the retained earning value, things are slightly complicated because we need to find that using these equations. Right, so this is the answer, guys, for Roman number 2. Done. Okay, now, guys, we are done with this part. Right now, guys, listen. Now that we have got the retained earning at the acquisition date, guys, over here, now I will complete this table because in my question, I don't have fair value adjustment. No, so what I'm going to do now, I'm now going to complete this area. Right now, guys, look at the way that I'm going to complete this. 4,000, 4,000, there is no difference. 12,400 to 16,005, there's a 4,100 difference. Total this up, guys, 16,400. And then guys, when you total this up, 20,500, then guys, 4,100. So guys, always remember this answer, the acquisition date net assets will go over here, 4,000, 12,400. And 20,500 has no worth or has no purpose at all. 4,100 guys, post acquisition. So you have to split between parent and NCI. So I said, guys, always see this way. The 4,100 you have to split to NCI, So go to NCI, post acquisition reserve 4,100, but 40%. Okay. Only the NCI share must be given 4,100 into 40%. 4,100 into 40%. Meaning, guys, the answer 1,640. Whereas, guys, over here, you have to give it to parent. Always remember, guys, if you ever forget parent share, where should I give? It's like this. Always think. Now, parent, if you forget, ask yourself from where did we get this retain earning? No, guys. So go to retain earning and mark there 4,100 into 60%. So 4,100 into 60%, answer is 2,460. Okay. Then guys, next one, we can calculate the goodwill now. But the only thing now for me to complete this working, to complete my retained earning, I need this brought forward of the parent. Okay. Now here I have this, but this is missing now, guys, brought forward of parent. So go back to the question paper one more time. It's not easy. Okay. Go back to the question paper, guys, one more time. See, retain earning brought forward of parent. Parent has 35,400. Copy it over here. Okay. Now, guys, what we do, let's go down now. So now, guys, we can start to find the answers for what we want. Okay. Now, guys, over here, look at this part, guys. Non-current asset. So non-current asset, guys, over here, see, property, plant, and equipment. Okay. So that's the answer that they want over here for non-current asset, which is the property, plant, and equipment. Then guys, over here, current assets. So guys, what you should do is you have to update this section, mark the answer. Then guys, current liabilities, you should guys update this section over here and then get your answer. So that one, guys, just adding and subtracting, you will be able to do that. Okay, guys, if possible, can you guys answer these parts and show it to me, guys, faster? Item number 3, task A and task B. Can you look at my workings, what I have given over here? And guys, can you select the answers quickly, please, for this question? Item number 3 and task A and B. Task 2, you have the answers now, guys, on the screen. I'll show the screen a little bit later. That you are just add and subtract and mark it. Right now, guys, find these answers quickly for this page. Item 3, task A and B. Right. All right, guys. So all of you have sent the answers. That's nice to see. Okay. So let's see, guys. Okay. 323. A second one. Yeah. So guys, very good, guys. So three students, guys, responded with the answers for the question. Very good, guys. All your answers are correct. Super. So over here, guys, like this. Number one, what is the formula for goodwill? So normally, guys, goodwill, what we do, take the investment, which is the fair value of consideration at the NCI and reduce net asset at the acquisition date. No, guys. So therefore, this has to be the answer. Fair value is the investment at the non-controlling interest minus net assets at the acquisition date. Right, non-controlling interest, guys, this is the answer. Okay. So the answer is going to be like this. See, 4,000 into 40% into 3.5, which is this, plus 40% of 4,100, that part only, guys, this, minus 40% of 250, which is this. Okay. So that's how we get the answer. So it's very tricky the way that they have given the numbers. Right, retained earning, guys, how did we get that? 35,400 is this. 4,100 into 60%, which is this. And then 250 into 60%, which is this. So guys, Roman number 3. Right, so this is how, guys, we get the answers for this question. So guys, I think if I'm not wrong, by doing those two questions, every possible adjustment from consolidation we have covered. Usually, guys, consolidation, these are things that normally comes, no. First you should learn the mechanism, like how the workings are done. Then fair value adjustment, that got covered. Then current account, trade receivable, trade payable. URP, both types selling we did. Then, guys, in our syllabus, we have share exchanges. That also we covered over here. And then if the retained earnings at the acquisition date is not given, how to find that? That also we did. So all the possible adjustments, guys, that can come for consolidated SOFP, we have covered. So we just still have 20 minutes left. So I think we can do one question at least halfway and then continue it in the next class with the income statement. I think, guys, would be ideal. So we did a tough question. Let's see, guys, any other question that we can try. Question that we did. Okay. We'll just try this question over here. We just do what we can with the time that we have. Okay. This one. So I'll just mark and give you all a few things. Only if you all can start off that one, guys, for the time being. This has to be enough. So this is also, guys, a question where the share exchanges are involved. Okay. Right. So guys, can you try to get the answer by reading this particular paragraph? Okay. By reading this particular paragraph, guys, can you get the answer for A, B, and C? So guys, remember, A and C would not be a problem at all. Only B, you have to be careful because they are asking the double entry for the share exchange. I gave you all the double entry earlier, guys. Same thing is what they are asking. Okay, right. Can you guys little bit try this question and see guys over here, A, B, and C, pentagon and square question. Okay, right. So guys, were you all able to sort out that one guys over there? A part, no? Right. A part Yeah, good. Total is 250. That's correct. Only thing you just have to show small breakdown for the examiner. That's it for the A part. Like you have to show for him how much is the cash and how much is shares. No need the calculation, just how much is the mark. Okay, right. Yeah, that. So guys, let me check that. I think that investment. Okay, right. Let us then guys discuss the answer. Okay. Now, guys, first thing what you should do is this. So they are telling Pentagon acquired 75% of the shares for a total of 250. So, guys, total consideration is 250. Okay. So, guys, from this 250, 150 immediate cash. So, I'll put the immediate cash here. So, guys, then basic math, the difference has to be 100,000. Okay. Totally we paid 250. From that 150 is cash, means guys remaining should be 100,000 no, and it's positive. Then only you will get 250. So therefore guys, it has to be add. Right. Normally guys, how do we get the goodwill? Right now, normally guys, how do we get goodwill? Consideration plus NCI minus the net assets at the acquisition date. So it's going to be guys like this. Now here everything is plus. So this can't be the answer. Here it's this and less. No. So answer guys has to be this one. Fair value of consideration, which is the investment, plus value of NCI minus the net assets at the acquisition date. Now guys, the only thing what we should do is just discuss this part over here, the B part. So now guys, this is related to share exchange. So I gave you a formula like this. Number of shares in the subsidiary company, multiply that one by percentage acquired, that you multiply by the nominal value, okay, and then you multiply that by the ratio. So same way guys, another one time also you have to do the same equation, but this time without multiplying by nominal value guys, you have to multiply this by the premium value. So therefore guys, the double entry would be number of shares in subsidiary company. Like now guys, look at this part. Subsidiary square, he has 40,000 shares at $1 each. So 40,000 divided by 1, there are 40,000 shares in subsidiary company. Okay. Okay, now guys, what you do, you have to multiply this by percentage acquired. Okay, so what is the percentage guys that has been acquired? The question paper says 75% has been acquired. So 75% over here and then 75% over here. Right, nominal value. Nominal value is guys $1. How did we get $1? This one. Normally, guys, the value that's given over here is the nominal value, the minimum value. Right. Then, guys, over here, we should multiply by the premium value. The premium value is 1.5. So, guys, how did I get 1.5? It's like this. Understand, guys, the meaning of premium value. So, normally, guys, premium value is like this, no? First, you take the market value. The fair value means market value of Pentagon is 2.5. So from 2.5, nominal is 1, the minimum, this one. Therefore, guys, the remaining answer is going to be the premium, which is 1.5. So take the premium answer, and then that's how, guys, I got it over here. Now, guys, you multiply this by the ratio. So what's the ratio, guys, they are going? The balance consideration is a share exchange, 4 for every 3. 4 for every 3. That means, guys, multiply by 4, divide by 3. Here also, guys, multiply by 4, divide by 3. So here, guys, the answer would be 40,000. This should be share capital credit. Here, guys, when you multiply, answer is 60,000. This is the premium, no? So therefore, guys, share premium credit. So 40,000 credit, 60,000 credit. So therefore, guys, investment should become debit 100,000. Debit. Issued share capital 40,000 credit. And the share premium 60,000 credit. This is how, guys, we should get the answer for the P part of the question. Right? So again, guys, how did I get 100,000? Add these two, 40 and 60. Once you add, you will get the investment. Right, little bit check and see, guys, are you all okay with the calculation, what I have done and the answers for ABC? Any doubts, you can ask me. All clear, no? Right. Okay, right. So guys, then with that part, then we will conclude then today's revision session. Next week, when we start off, we will first complete this question and we'll see whether we can do another one, consolidated SOFP. And guys, I'll be then teaching you all consolidated income statement. Income statement, guys, very easy. A very small part that I have to explain. We can do a lot of questions in that. Okay, right. So guys, I'll conclude the class, guys, at this point then today. I'll see you all again then next Monday at the same time, 6 p.m. Okay. Yeah, sure. No problem at all. Yeah, I'll show you. Wait. Okay. So guys, I'm going to clear the screen. Just let me know, guys, if you want anything to be there. All right, guys, welcome then. Right. You can take the screenshot. Done, no? All right, guys, then. Barakallah. Right. So guys, I'll see you all then next Monday. Okay. Right. Guys, welcome. Right. See you guys.